It's a very simple structure. Obviously, because I can't justify my fees if everything was this simple, we've come up with complications on that. But the essence of it, Jonathan Fleischer leases a car. The lessor sells that lease to the sukuk. Jonathan Fleischer pays the sukuk. He can use an administrative agent, being the original lessor, to pay that. Very simple. We then add different levels of complication onto it. So it's what I call there's two models. One is the defined asset model, which is sort of the GE structure, which I understand is more of an asset base as opposed to asset-backed structure. You have a single asset, usually in GE's case, it was a very expensive plane. Investors put money into the SPV. The SPV buys the asset from the lessor, the obligor pays, and then there's an obligation back to the originator at the end of the term. This can work either with the obligation of the originator or having other possibilities to get out of the transaction. In our traditional structure, we're always looking at the creditworthiness not only of the obligor, but the value of the asset. With a sukuk, it could be both ways, depending on what you want to do. The other, and this is to me is the more interesting opportunity that exists in the Canadian market right now. As all of you know, we've gone through a credit crunch in the last little while. The people who suffered most in the credit crunch in the equipment finance industry have been the relatively small lessor who do maybe 40, 50 million a year. They've been having trouble finding financing. So what they're looking for is somebody who will help them aggregate their leases, sell it into an SPV, and then purchase the leases from them. Prior to the credit crunch, Manulife and Sun Life had that role. Post-credit crunch, they still have that role, but in not as large a way as they had in the past. The sukuk can fit into that model without too many amendments to existing documentation. The big issue that you get into in structuring a sukuk is it a true sale from the originator into the to the sukuk, or the special purpose vehicle? Nice thing about Canada is the answer is if the parties intended to be a true sale, it will be a true sale. This is relatively new law. I think about 5 years ago, there's a BC Tel case which set out the rules that must be followed in order to have a true sale to occur. It does allow recourse back to the originator, but it focuses on what was the intention of the parties. When you look at the US transactions, for instance, they tend not to see true sales as liberally as we do in Canada. So Canada does provide a fairly strong vehicle for you to be able to create the sukuk in methods that will give you the desired results. So we are able to provide for that. There are some issues in Canada with the introduction of IFRS from an accounting structure. However, from my understanding, that's not as big a concern for the sukuk structure, because you're not focused on the accounting of the sukuk. You're more focused on, do you have the asset or is there claims back? So I'm going to spend about 2 minutes just on what the market in Canada is for leasing. And I know I think at the end of the day you're going to have a session of opportunities in Canada, so I'm going to run through this very, very quickly. But in Canada, leasing originates about $22.6 billion a year. And the type of assets that tend to be financed tend to meet the Shariah requirements. They tend to be trucks and cars. They're not, mining equipment, all halal equipment. So that's good. It's mostly in Ontario, Alberta, and Quebec. My one comment is that Quebec is different than Ontario and Alberta, as you probably know. So we have to be more cautious when we're talking about Quebec, but it's still a terrific market. And most of the principles that I'm talking about here also are true with Quebec, but nothing I say should ever be construed as to be true in Quebec, because you have to guess most of the time. The market in Canada is mostly commercial equipment of about 18 billion, and the major lessors right now are the banks, the CITs of the world, and the independent finance companies. It's the third group in there, the independent finance company, where the opportunity exists. The banks right now, there was a liquidity crisis. I'd say the liquidity crisis for the most part has abated to a certain extent for the very large banks. Even the CITs of the world are getting financing. They closed a $1 billion financing yesterday, so they seem to be gaining their liquidity back. The independent finance companies, on the other hand, are not. So there is an opportunity there. You have to look at the market. If you're looking at the defined asset market and you just want to do a single asset, that's a very, very competitive market. Rates tend to be a lot lower, and they tend to syndicate out those facilities. Where I think that would fit in perfectly for a Sukuk-style financing, at a legal level, at a business level, it will be a little bit more challenging because I think you're going to find much greater competition. So it can occur, but you have to be mindful that the returns that you're going to get may not be as good as they will be in other areas. So as you move down the market, in the mid and small ticket, rates tend to be higher. Because rates are higher, you will have more competition and liquidity is less right now. So that's where the opportunity exists. So the next question would be, what has to happen in order for a traditional Canadian lease facility to work for a Sukuk? The good news is, and the reason that I was always attracted to this area when Brian discussed it with me, is that within the lease market, there's very little that has to change. Unfortunately, for Shariah compliance, you would not be able to do consumer leasing because you do have to, under at least Ontario law, and I think all of the provinces, I'm not sure about Quebec, you have to disclose interest rate. So that wouldn't work for Shariah, but for the commercial market, it would work. Because there is no, the nice thing is, as I think you all know, a lease in Canada does not require a disclosure of an interest rate. All other forms of financing in Canada, pursuant to our Interest Act, require that the interest rate be set out. A lease does not, except for consumer leases. What I'm going to list here, I've written a paper which is at our firm's website that you can take that goes through these in more detail. I'm just going to run through them very quickly, but you'll see that there's everything that needs to be done for Shariah compliance can be done with some moderate changes. And if there is an appetite to create that, you can go to the originators and say, you have to change your documentation minorly in order to allow yourself to have a new avenue of liquidity, which is really what I'm trying to leave with you. There is a possibility for a market in this area. As we go through the various issues that have to go, they're not, nothing here is all that problematical. The terms are set out. The maintenance requirement, usually it's the lessee who maintains the equipment pursuant to a lease. That may cause some issues that can, again, be structured around. Insurance, typically in a Shariah lease, the insurance is supposed to be taken out by the lessor, not the lessee. That can be built into the transaction in Canada. It's the reverse that occurs, but again, it can be structured around. The big issue that you're going to find on large ticket in Canada is with respect to the period before the equipment is actually put into service. Because if you're going for a very large transaction, there's progress payments that often have to be made to the manufacturer of the equipment. The question is, how do you finance those progress payments? There are ways of structuring around that. And I think that's pretty much where I'm going to leave you because I'm going to use up too much of John's time. But the short answer is anything can be done that you want done. John?
Thanks, John. John and Brian have obviously given you the good news story about compliant structures. I'm here to sort of talk about what happens if things go wrong. And I'm pleased to say that Canada has a very robust insolvency regime. Not only is it robust, it's very up to date. In fact, we just had an extensive set of amendments to our insolvency laws that were put into effect last year. I'd just like to give you a bit of an overview about this so that you have an understanding about what happens, what are the recourses if there's an insolvency. And we're really talking about an insolvency of the borrower, of the obligor under a Sukuk arrangement. Canada really has two sets of federal insolvency laws. The first one is the Companies Creditors Arrangement Act, and those of you who are familiar with the Canadian scene know that that's the statute that is used for very large restructurings, such as Air Canada. In fact, you have to have a debt of more than $5 million to get under that. So that's the primary statute for restructuring. Sometimes that statute is used for liquidation because the restructuring isn't going to succeed, so a liquidation is done under the auspices of that act.